Anyway, so it's one of those things. So 206, let's go. Hit me. 3,700, we go. 3,800. What we got? 0.97. Current ratio. Now, with current ratio, hey, quick. Yes. Just that when you go advanced level, there is a difference between the two. Okay? But I won't tell you the difference here. When you go advanced, there is a difference between acid test and quick test. The reason is that you may have trade receivables, which is a long overdue debt. Are you getting the idea? So you've carried that for about 5 years or 10 years now. But when you're really testing the liquidity ratio of the company, talking about something like the quick ratio acid test, you may deduct what? That long-term trade receivables. But at this level, you don't need that. So all you know is that acid test, the same thing. So current assets minus what? Inventory. But in this case, we have to take into consideration what? The held for sale. Because if you check, let's go back to the question. You see that the held for sale is part of where? The current asset of the company. So we need to take it out when we are dealing with the asset test ratio of the company for 2007. So what do I have? 9,500 minus inventory is what?
Inventory is
1,500. And then the held for sale is 6,000. Let's go. Over 4,500. What do I have?
$0.4.
0.4 times. What about 2006? 3,700 minus what's the inventory?
1,000.
Over 3,800. What do we have? Now, okay, it says appropriate 5. You know, from this question we can calculate many of the ratios. We can do asset turnover ratio. We can do what? Trade receivable days, trade payable days as well. All can be calculated in this very question. But you see that one of the ways to help us interpret ROSI very well, gross profit and net profit margin very well, is the asset test ratio. Sorry, the asset turnover ratio. Because you know that when the asset turnover ratio is increasing, your ROSI should also increase. So that if it is not entirely like that, then you can properly what? Interpret the ratio. For that reason, we are going to calculate the asset turnover ratio. But how much on that? So much on top, so I can only have 206. There was value for it. Was there value?
Yes.
For 206? For asset held for sale? It's nil. It's nil. Check your balance. Where is the note? The carry amount for asset of discontinued operation 6,300. Okay. No, but we won't consider it for 2006. Because it is nil here, we will take what is here. Alright? So we won't consider it in calculating our current ratio, our quick ratio. Okay, because it's nil here. So the value here is telling us the value prior to what? The year under discussion. So if it is not in the balance sheet, meaning it wasn't disclosed in the balance sheet, as at the end. Are you getting the idea? So let's go for asset turnover. Why am I talking about asset turnover like that? Asset turnover. What's the formula? Asset turnover formula. What's it? Inventory turnover now. Shame. Revenue about capital employed. So asset turnover is how much revenue the company generates from each $1 of what? Assets employed. So let's go. Revenue. 2007 revenue. 27,500 over capital employed. So we have already done the workings for it also. 16,500. What do we have? Mm-hmm. 1.6. 206 revenue.
21.
Capital employed. Hey, revenue is 21,200. Okay, capital employed. What's our capital employed?
11 to 9.
Okay, so what do we have? Okay. You see, in this question, even though the examiner said we should calculate 5 appropriate, to really interpret the thing, you have to calculate more than half. More than half. But we can limit ourselves to what he said and go ahead. So, if we are interpreting, what do we say? You know we are not writing a report, right? I told you in a report, you do the from, to, subject, introduction, then you write it out and you begin. So if we are interpreting, what do we say? Let's look at the profitability ratios. What do we see in Rosie? How did I say you interpret? These are the principles. Number one, tell us about the change in the ratio. Number two, tell us the possible what? Causes of the change. Tell us about the consequences. Or the effects of that on the financial statement, on the entity, and then possibly you can make what? Recommendation at your conclusion. So number one, what is the change in Rosie? Is it increasing or reducing? It has reduced. By how many percentage? So what do we say? What do we say? What could be the possible reason for the fall in the Rosie? What could be the possible reason? Asset turnover, so what do we see here?
There's a 4.
We see a fall. Now, of how many percent? By what? What?
11.6.
11.6%. Now, so if your asset turnover falls by 11.6% and your ROSI falls by only 1.3%, what does it inform? Now, we are having a discussion about this. I'm not going to write anything, but you just have to understand how the interpretation goes. I told you that when you're interpreting ROSI, one of the ways to better understand ROSI is to calculate what? The asset turnover. Because the asset turnover tells us how much money we are generating from the asset employed. So if we are generating more, we should also make more profit. Now, the revenue we are generating is falling by 11.6%. But our return on capital employed is falling by only what? 1.3%. And we are asking, what could be the possible cause? What could be the possible cause? Number one, substantially, we can see that capital employed has what? Increased. Are you getting the idea? Capital employed has increased. So percentage of change in the capital employed is small. So that could be the reason why it is falling. Can we confirm that from anything in the question? Yes. You see their 5% loan note was 3,000 last year. Sorry, 5,000 last year. But it is now what? 8,000. So it has increased by how much? 3,000. That could be one of the reasons why our ROSI is falling. But if you check the percentage of fall, the revenue is falling by 11%, but ROSI is falling by only what? 1.3%. Meaning that possibly the company is managing what? Its cost well, comparatively. Meaning the company is managing its cost well. If we go back to refer, let's see. Yeah, possibly the company is, so possible causes: 1, change in what? The capital employed. 2, the company properly, it's managing what? Its cost in the current year. That could be one of the reasons that we can say about that. Anything else? Anything else we can add to the interpretation? So, number 1, deal with the change in the ratio. Number 2, talk about the causes. The causes, you can talk about 2 or 3 of them possible causes. That you can talk about it in relation to that. Okay. Okay. So that's it. Now, what this indicates to us at the end of the day is that there is a fall, or if you want, decline in the efficiency of what? The company. There is a fall or decline in the efficiency of the entity. Why? Because if your capital employed has increased, the meaning more revenue should be what? Generated. But if your capital employed increase and more revenue is not generated, that means your efficiency has what? Fallen as a company. So that is what we can talk about in relation to the ROSI for the company. But you know, as I said, when you're explaining profitability, make sure you intertwine it with all of what? The ratio, so you are connected. What about gross profit margin? What happened to that? Did it fall or it increased? You said? Did it increase? What? 29.1. And then? Oh. So, gross profit margin substantially is almost what? The same. Meaning that yes, the company is still not what? Efficient enough. Because yes, what it means is that at least once your capital employed has increased, more revenue should be generated. So this one further also confirmed to that to some extent that what? the company's efficiency is not up to par. That's one thing we can say about that. What else did we calculate? Net profit margin, did we do that? What is that also about? Did it fall or it increased? Okay, substantially what? The same. Okay. So yes, so we can conclude on the average that when it comes to the profitability, yes, the company's efficiency is declining, taking into consideration what? The asset turnover and then what? The ROCE. However, considering the gross profit margin and the net profit margin, there is no substantial change from last year to what? The current year under consideration. And this can be attributed to what? If there is no substantial change in your gross profit margin and net profit margin, what can it be attributed to? It didn't increase, it didn't fall, it is almost the same. What can it be attributed to? What? So if your margin and your ROCE, your margin, net and gross are the same for last year and this year, then to some extent, yes, we are not efficient in generating revenue, but the company may be efficient in managing its costs. Are you getting the idea? So that because they did not generate more revenue, that is why they didn't incur more cost. So substantially, they are incurring the same cost they incurred last year as they incurred what? This year. That is why substantially, their net profit margin and gross profit margin are not changing. I hope you are getting the idea. So that is what we can talk about in relation to that. Then we come to liquidity ratios. What did we do under liquidity? What was the thing? Like, did it increase or it reduced? From to 2.1. Wow. And then the quick ratio decreased. Now, to better really interpret the current ratio and the quick ratio, what did I tell you? I told you that one of the ways to really confirm what is happening at the liquidity level is to know the thing about the trade payables days and what? Trade receivable days. So even though they said we should calculate only 5, to make our interpretation well, we need to go beyond what? The 5. Otherwise, liquidity ratio, you just say it increased. Why? You'll be giving some reasons that are not really what? Solid. So to make our reason solid, let's do quickly trade receivable days. What are we going to have? For 2007. What do we have? 2,000 over sales. Over sales. Is it 27,500 times 365? Hey, trade receivable days. So trade receivable days. So trade receivable days, not payable days. What do I have? Then let's go to 206. 26 days. 2006, what do we have? 2,300 over 21,200 times 365. Still for 2006. How many days? 40 days. So trade receivable days is falling. Wow. And I'm saying that liquidity is increasing. Okay, meaning more cash is coming into the business, something like that. Let's go. Trade payable days. Can I have answers? Payable days is what? The payable divided by purchases or cost of sales. We go. 2007. 2,400 over cost of sales. 19 times 365. 45 days. Then trade payable days still but 2006. 2,800 over 15,000 times 365. Oh, really? So what do we see? Okay. So substantially, trade receivable days is falling, and trade payable days is also what? Falling. And I will say, your acid test ratio, what's happening to the acid test ratio?
It's falling.
Falling by what percent?
70.
Or it's not substantial? It is what and what?
0.6.
And then?
0.4.
Okay, so the fall is not substantial. But then give me quick ratio. Is it falling or in? Relax. Give me current ratio. Is it falling or increasing?
Increasing.
Of how what?
It's 2.1 as against 0.97.
So, okay. But you know the crux of liquidity is really what? The acid test ratio. So if you check, what do you say about liquidity for the company? Now, in 2006, the liquidity was 6.2, 0.62. Now it has even fallen further to what? 0. The acid test. But he said it was 6.2 in 2006. And then 2007, 0.4.
Yes.
Now, the benchmark for liquidity is that it should be greater than or equal to what? 1. Now, it being 0.6 Nankasano, it's not good. Now, it has further gone to 0.4. What does it mean? It means that the company is not what? Managing its working capitals efficiently. So meaning at this level also we can say that the working capital management policy of the organization is inefficient. Okay? Looking at the percentage fall in the acid test ratio and the fact that it is not meeting the benchmark. Now, how could we also say that trade receivable days is falling? Do we see cash of the company increasing? They don't have cash. they had bank and they had nil in the current year. Can you see that? And last year they were not having overdraft, but this year they were having a huge what? Overdraft. So as you can see, the company is struggling. So look at it. Even though they are taking money at a short time from their debtors, what is the debtors figure? Has it increased or reduced? It has reduced, isn't it? So even though they are taking the money shortly from the people, they are also paying their suppliers what? On time. But then, why is that happening? What about inventory? What is happening to inventory? Inventory has increased slightly. Can you see that? Now, it could mean that the reason why the company is working capital is suffering or not managing working capital properly goes back to the asset turnover ratio, which means we are not generating what? More revenue. Because we are not generating more revenue, Kakrana is generating, that is what we use to pay what? The suppliers on time. So the rest of our operating expenses, we go and borrow what? Overdraft to come and finance that. So you see that here again, this is confirming what we did under what? the asset turnover ratio. So you look at how I'm doing my interpretation, taking into consideration the change in the cash or bank, taking into consideration the change in the trade payable days and then the trade receivable days, taking into consideration what is happening in relation to the asset turnover ratio, because these three things direct us about how the organization is what? Liquid. So this is what we confirm. So in conclusion, yes, working capital management policy of the company is what? Inefficient, and if a quick decision is not made, the company will be what? Will go into bankrupt. Because as you can see, long-term liability has increased by 3,000. Overdraft facility has increased by 1,150. So long-term finances, short-term finances are what? Increasing. Meaning the company is financing its operations with what? Debt rather than equity. That is what we say under the liquidity ratios. Very important. Very important. So we're going to take a lot of preambles into consideration when interpreting the liquidity ratios. But the question is, in the exam hall, can you think like this? The answer is yes, you should be able to think on this line. If not, then your interpretation will be porous, will be weak. That's why I said, and you see, if you look at it, it has fallen by 2%. Then, and so what? Go deeper. Tell us, how does this relate to this? How does this relate to what? This. That is what we want to understand, because you are what? Analyzing the financial performance and the financial position of the company. So if you check, now this company is financed by debt. So the financial position wise, they are not good. They are not good. They are not good. Now, from there, I always tell you this boy is very important. In conclusion, we say that the company's financial performance overall declined from what? The previous year to the what? Current year. So financial performance is declining, even though, no, you don't write my word though, even though the capital employed is increasing. Now, check something for me. Is the shares of the company increasing or is the same? Shares remain the same. So this capital employed increasing is financed solely by what? Debt. Which is not good for the company. So financial performance is declining even though capital employed is what? Increasing. Which means that the company is not what? Efficient. Which is what we've said already. Then is it? Highly risky. So the financial position wise, what do we say? The company's liquidity is beyond, far beyond. So this company is actually heading towards what? Bankruptcy. It's heading towards bankruptcy. Bankruptcy. If decisions are not made what? Now, this one confirms why they closed down the factory. Because maybe the product they are producing, people are not buying. So you can suggest here that the reason why they closed down the factory, or you can suggest here that maybe the company should consider leaving the market they are in or diversifying or producing what? Another product. Because financial position wise, this company is heading towards what? Bankruptcy. Because your liquidity ratio is porous, you are borrowing more money, both in short term and what? Long term. Now, when we leave this company to run for the next 12 months, loan facility will move from 8,000 to somewhere around 15,000. Then the bank overdraft may exceed what? The minimum given by the company, by the bank. So, meaning this company is not in a good shape for us. So this is something we can write or we can discuss about the analysis. Please, as I said, it is not about my word. It is about how the analysis is supposed to be, or how your appraisal is supposed to be written. So you don't do it in isolation, you do it in groups. So when you take profitability, Deal with it, let the ratios intertwine with each other. Asset turnover, ROCE, profitability, gearing. Let them intertwine and give an explanation on it. When you are taking liquidity, don't just take the acid test and quick test ratio. Intertwine that with the trade receivable days, trade payable days, and then changes in the cash and changes in the receivables and what? Payables. That will help you to reach a solid conclusion and really give a good interpretation of the financial statements of the company. Really, when we are talking about interpretation, is the profitability and the liquidity really that we are what? Looking at. Even though we can talk about the investment ratios. You don't like that one? So that is it about that. Any question, please? Any question on the interpretations? On the interpretations? And your first question to answer in the exam one. Okay. Okay. So that's it. So let's go to question 5. The question on high purchase. And let's see what we are supposed to do there.
So, explaining the liquidity.
Yeah.
Even on this question, for instance, we were not given the ratios to calculate.
No, we were told to calculate 5 appropriate. Yes. Now, this is a new area. I think I gave you an overview of this during our revision session, and I gave you an introductory question on that as well. You were not here. So let's read it through and then let's answer this question. On 1st March 2017, Premium Shopping Mall commenced business selling laptops to government workers on hire purchase. Very important, we need to take the dates of commencement of business into consideration. So 1st March 2017. Under the terms of the agreement, an initial deposit of what? 35% of selling price is payable on delivery, followed by 7 monthly installments. The first due a month afterwards, the date of sale. Okay, so every customer who buys is supposed to make a deposit of how much? 35% in the month of purchase, and then the rest will be made in what? So balance in 7 equal installments. Very important. Okay, very important. During the year ended 31st December 2007. Now be careful. They started 1st March 2017 and the year ended is what? 31st December 2017. Meaning how many months? March, April, May, June, July, August, September, October, November. This 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10. 10. Right? Because not 31st March. Okay. During the year ended 31st December 2013, sales were made as follows. So we are giving sales on 9th March, April, June, September, October, and what? November. Now we are giving the cost price and then what? The high purchase price. You know, in high purchase, what's the difference between the cost price and the high purchase price? What did we say is the difference? Cost price and high purchase price. What did we say is the difference between that? Come on, I said this. Don't lie to me.
Yes.
Say the difference.
Yes. What's the difference between the cost price and the high purchase price? Why?
Because of the days you need to pay.
Because what? Interest. Is it interest? Are you saying because it's inclusive of interest? Now, this is not purchases price and high purchase price. Sorry, cash price and high purchase price. Cash price is what you pay now if you are what? Buying it now. High purchase price is what you pay if you are buying it under what? The high purchase agreement. So the cost price here is just the cost of sales. Are you getting the idea? In other words, the cost of buying the, what are we selling? Laptop. So the cost of we buying the laptop and selling the laptop, that's it. So our cost is these respectively, but because we sell at the high purchase price, we sell it at this price. So all sales are made on high purchase, so we don't have cash price here. That's what you got to understand. Now let's look at the additional information. The computers sold in July were repossessed in when? October, after Ibaze, and non-payment of September installment. The repossessed, make that correction. The possessed computers were eventually sold in December for how much? You said? There, you see, it is there as there at 140 million. Is it 140 million? Yeah. 140 million. Okay. Cash. All other installments were paid on the due dates. Okay. Gross profit and interest. Now that thing it was together, but it's supposed to be one word. It's supposed to be in sentence. So gross profit and interest credited to what? Are credited to income statement in proportion that deposits and installments received bear what? The high purchase price. Bear the high purchase price. Required. Prepare a high purchase income statement showing profit or loss on the high purchase transaction, including the repossessed goods and statement of financial position for the year ended 31st December 2012. Okay, so let's deal with a couple of workings that we need to look at. Okay. I think I'll deal with that in the next video, so click on play for the next video.